Underwriting guidelines are the foundation of how insurance companies decide what risks they are willing to accept and under what conditions. They serve as a roadmap for underwriters, ensuring consistency in decision-making, risk selection, and pricing. But how are these guidelines created, and what happens when market conditions shift, requiring insurers to make adjustments? Let's break it down. When an insurer develops a new product, underwriting guidelines are built from the ground up. Let's use the example of launching a new usage-based auto insurance program. The company starts by researching market demand, regulatory requirements, and potential risk factors. The insurer's actuaries and data scientists analyze historical loss data, telematics data, and other risk indicators to determine pricing models and eligibility criteria. Based on these insights, the underwriting team drafts guidelines, specifying who qualifies for coverage and what risk factors require additional review or exclusion. For this usage-based auto program, the insurer might decide to approve drivers who maintain safe driving scores based on telematics data limit coverage for high-risk age groups, and exclude drivers with multiple speeding violations. Additionally, vehicle eligibility may be restricted to cars with built-in telematics capabilities. These guidelines provide a framework for risk selection and ensure the product is both competitive and profitable. Once the product is live, insurers continuously monitor its performance. Let's say after 1 year in the market, economic inflation causes repair costs and medical expenses to skyrocket. Claims payouts rise significantly, making the product less profitable. In response, the insurer must revisit and adjust its underwriting guidelines to maintain financial stability. They may implement stricter criteria for driver eligibility, require higher deductibles, or adjust premium rates based on inflationary trends. This process is a crucial part of insurance operations, ensuring the product remains sustainable in changing economic conditions. Changes to underwriting guidelines can have far-reaching implications. If the insurer tightens its acceptance criteria, fewer drivers may qualify for the usage-based auto program, reducing its market penetration. If rate adjustments are too aggressive, customers may look elsewhere for coverage. On the other hand, failing to adjust underwriting guidelines in response to rising claims costs can lead to unsustainable losses, forcing the insurer to exit the market altogether. This balancing act between market competitiveness and profitability is why underwriting is both an art and a science. Beyond individual insurers, shifts in underwriting guidelines can impact the broader insurance market. If multiple companies raise their risk thresholds, it can create a hard market where insurance capacity shrinks and premium costs rise industry-wide. Conversely, when competition increases and insurers expand their risk appetite, it can drive down premiums and make coverage more accessible. Underwriting guidelines are never set in stone. They must evolve in response to emerging risks, regulatory changes, and economic factors. The rise of new data sources, AI-driven underwriting, and climate change considerations are all influencing how insurers update their guidelines. For example, insurers are now incorporating climate risk modeling into property underwriting to account for increased catastrophe exposure, while AI is being used to refine auto insurance risk factors in real time. For those interested in working in underwriting or risk management, understanding how guidelines are developed and adjusted is a key skill. As the insurance industry continues to evolve, those who can navigate underwriting changes effectively will play a crucial role in shaping the future of risk selection. If you found this explanation helpful, don't forget to like, subscribe, and follow for more insights into the insurance industry. Let us know in the comments what topics you'd like us to cover next. Thanks for watching.